This is mine and Frank's presentation on our investment portfolio. So just to start off with a little client introduction. We decided that our client is a recently retired individual looking to save up on some money to assist with their grandchild's university education. They're a low-risk individual and are looking for a predominantly low-risk investment. They are investing 100 grand into the portfolio. So we have decided to do 5% of the investment into cash. We want this amount in cash to be in the lowest risk class, as banks are extremely unlikely to default on their debt. The interest rate on the cash is determined by the Bank of England, and it currently stands at 4.5%. So in this case, in the first year, our client's savings account would earn £225 on the £5,000 invested into the savings account at the current exchange rate. It's also vital to have cash in an investment portfolio in case our client needs any easy access in case of any emergencies or unexpected expenses. The risk involved is including interest rates. So if our client wants the cash in a fixed savings account, the base rate could increase, meaning that the rate in the account will be below what the current rate is, meaning they're missing out on interest payments. Despite this, in the economic climate, interest rates are on a downward trajectory in recent months, coming down from 5% and is predicted to continue falling, meaning that fixed savings account would be our suggested route to go down for our client. A means of statistically analysing whether the interest rate is at a good level for savings is if the rate is below current inflation. Using this, we are currently in a poor climate, as inflation has just been announced by the Chancellor to be at 2.8% in February, meaning that is well below the 4.5% base rate. Despite this, as mentioned before, interest rates are predicted to reduce in coming months, so it will make the position stronger. The interest earned from the savings account will be taxed as regular income, meaning that our client will add this onto their income and will then be taxed using the standard UK income tax brackets. So the majority of our portfolio will be put into bonds. We want to put 60% of the investment into the bonds due to the low risk nature of them. Of the 6%, we want to put 75% into different government bonds, as these are low risk due to the unlikely nature that a government will default on their debt. We want the remaining 25% put into corporate bonds, which are slightly more high risk as they aren't as trustworthy as governments. However, we will put these into reliable companies that are, again, unlikely to default. So specifically, we want to put 70% of our allocated government bonds budget into gilts and UK government bonds. We've chosen two ultra short conventional gilts, which is a 4.125% gilt and a 3.75% gilt, both maturing in 2027. We've also chosen three short-term conventional gilts at 4.5%, 4.375%, and 4.125%, maturing in 2028, 2030, and 2029. We're analysing it using the yield to maturity rate as a way of statistically analysing whether these are good. Is that if the yield to maturity is higher than the coupon rate stated, it means that our client will be buying them for a discounted price, meaning that when they sell them at their maturity, it will lead to higher returns on their investment. So therefore looking like a good option. For the remaining 25%, we've included two index-linked gilts in order to protect part of the portfolio from inflation. This means that the real value of the investment is preserved due to the interest payments also increasing as inflation goes up. So these are the two 0.125% treasury bonds maturing in 2028 and 29. On top of the UK gilts, we've also included the US Treasury bond in order to globalise and diversify our portfolio. This being a US 2-year Treasury note at 4.125% coupon rate with a yield to maturity at 4.043%. The reason we've used the US bond is because it's useful due to them being backed by the US government and the small likelihood of default. The remaining amount of the investment will be put into two corporate bonds. Despite corporate bonds being higher risk than government bonds, we have chosen two firms that have extremely low risk attached to them. That's the National Grid, and their bond matures in 2028. It's a low risk option due to it being one of the UK's largest utilities company. The other bond will be in BP, which matures in 2026. And this is low risk due to BP being one of the world's powerhouses in terms of oil and gas. These bonds will both lead to stable interest payments due to the size and reliability of the companies. For all the bonds, we've used short-term, under 5 years maturity, as they are lower risk than the higher maturity ones due to the likelihood of there being a global event. is higher the longer the maturity of the bond is. Due to this lower risk, it does result in interest payments being lower. But despite this, the bonds will mean that our client will receive steady income on these bonds and adds high diversification to the portfolio. Despite the positives of the bonds, they do have lower returns than equity. However, they do have a lower risk, which is our client's preference, and is why we have got majority bonds on the portfolio. Most of the bonds also have no protection on inflation, but with inflation decreasing currently, it's not a huge issue. The returns from these bonds are taxed as income and will fall under the income tax brackets. Once the bonds are sold, they are also not included in capital gains tax, meaning that these are very tax efficient for our client.
So the remaining 35% of the investment will be invested in equity, so stocks on the New York and London Stock Exchange. This is the riskiest asset class of the four. Potential returns are also at their highest due to this. Value of firms can rise quickly and potential for dividends is high. Defensive stocks are recommended in line with our goal of low risk investment. These typically stand the test of recession due to their safe nature, firms such as utilities and pharmaceuticals. Furthermore, investment within UK and US markets are low risk as these markets are more regulated. So some of the upsides and drawbacks of investing in shares. There are many potential upsides with investment in shares, such as the high liquidity, the ability to easily develop diversification of investment, returns often in excess of inflation, and the greatest returns in comparison with the other asset classes. The potential drawbacks are that share prices can change constantly and returns are taxed under dividends tax. So what are some of our potential investments? We would be going for low risk investments in historically safe shares. One of these is Unilever. This is a low risk equity option with a defensive business model. It typically survives during recession due to its essential nature. The firm has a strong global diversification. Its global presence means risks associated with regional economic downturns are reduced. A strong brand portfolio and historically reliable and consistent dividends make it an attractive low-risk option. So what is its beta value? The beta value, it stands at 0.46 as of March 2025. This means that the Unilever stock is less volatile than the broader market. In a market downturn, Unilever are less likely to experience steep decline in comparison with high beta stocks such as tech firms. Another attractive low-risk stock is Pfizer. The firm's beta value stands at 0.54 currently, also indicating a low level of volatility and a defensive stock model due to the essential nature of its pharmaceutical products. Furthermore, the firm benefits from government contracts for vaccines and medications, ensuring stable revenue. So how will these be taxed? Dividends from stocks are taxed under UK law known as dividends tax. Tax-free allowance on dividends as of the tax year 2024-25 is £500. Any dividends that deliver £50,270 are taxed at 8.75%. Dividends between £50,271 and £125,140 are taxed at 33.75%. Any dividends that deliver above £125,140 are taxed at 39.35%. Something to be wary of when investing in foreign stocks such as Pfizer is that the country where the company is based may withhold tax on dividends before you receive them. The US withholds 15% on tax dividends, so you may still owe UK dividends tax on the remaining amount. Then finally we have the market efficiency. So this is when investing in stocks and shares is the three classifications of efficiency pharma from 1970. So you have weak form when prices reflect all past information, semi-strong form when prices reflect all past and current publicly available information, and strong form. Prices reflect all public and private information. This may include privileges such as inside information. So there are three types of market efficiency to note. Operational efficiency aims to minimize costs, allocative efficiency aims to not waste resources, and information efficiency, which is central to the efficient market hypothesis. It is also vital to note that calendar effects have implications on investments. For example, stocks in January are generally abnormally high returns, and after a daylight savings weekend, returns are more negative. Thank you for listening.